Imagine waking up tomorrow and discovering that the people behind some of India's biggest companies have more influence over your daily life than most politicians ever will. The ports your goods pass through, the telecom networks you use, the airports you fly from, the steel, energy, technology, and infrastructure shaping the country around you. And behind some of it stand names like Tata, Ambani, and Adani. But here is the uncomfortable question: are we looking at a mafia or something far more complicated? Because the truth is not that these men secretly control India from a dark room. The truth is much more powerful. They built businesses so enormous that their decisions can affect markets, industries, workers, investors, and even the direction of India's economy. And that changes the question completely. How did a handful of business empires become so powerful? To understand it, we have to go back before the skyscrapers, private jets, giant ports, and billion-dollar deals. We have to go back to a very different India. In 1868, a 29-year-old Jamsetji Tata started a trading company with just 21,000 rupees. There were no massive conglomerates, no global brands, no modern stock market culture. Just one entrepreneur trying to build something in a country still under British rule. But Jamshedji wasn't thinking like an ordinary trader. He wanted steel, he wanted power, he wanted scientific education. He wanted India to become industrially independent. And that ambition became the foundation of what would eventually become the Tata Group. More than a century later, the Tata name would stand behind automobiles, steel, hotels, technology, aviation, and some of India's most recognizable brands. But Tata's story was only the beginning, because decades later, another entrepreneur was looking at India through a completely different lens. His name was Dhirubhai Ambani. In 1957, he returned to India and entered the yarn trading business. The dream was enormous: build India's largest company. And in 1977, Reliance went public. The IPO was reportedly oversubscribed 7 times. Something had changed. Ordinary Indians weren't just watching industrialists build companies anymore. They were becoming investors in them. The stock market was becoming part of the story. And Dhirubhai understood something that many traditional businessmen didn't. Scale wasn't just about factories. Scale was about capital. Capital could create factories. Factories could create revenue. Revenue could create more capital. And suddenly, growth could feed itself. But the real game was just beginning. Then came liberalization. India began opening its economy. Competition increased. Foreign capital entered. Old business models were challenged. And this was the moment when India's corporate landscape began changing at terrifying speed. Reliance expanded into petrochemicals, energy, telecom, and retail. The company that had once started with yarn was now touching industries that ordinary Indians encountered every single day. Then came Geo: cheap data, free calls, millions of users. Competitors were forced to react. The Indian telecom industry was suddenly transformed, and once again the lesson was clear. If you control the infrastructure, you don't just participate in an industry, you can change the industry itself. But somewhere else in India, another empire was preparing for an even bigger transformation. Gautam Adani began his entrepreneurial journey in the diamond trade before founding Adani Exports in Ahmedabad in 1988. At first, it looked like another trading company. Then came Mundra, and this was the moment everything changed. Instead of simply moving commodities, Adani increasingly built the infrastructure through which commodities could move. Ports, power, logistics, energy, airports, infrastructure. The strategy was simple but incredibly powerful. Don't just sell the product, control the road the product travels on. And suddenly, the company was no longer simply a trader. It was becoming part of India's economic plumbing. Think about what that means. A road is visible, a building is visible, a factory is visible, but infrastructure is different. You might never think about the port behind the products in your home. You might never think about the power station behind the electricity reaching your house. You might never think about the logistics network behind the food on a supermarket shelf. Yet, someone owns, operates, or finances those systems. And that is where economic power becomes difficult to see. But then came the fourth name, Tata, Ambani, Adani. And suddenly people began asking a dangerous question. Are these simply successful businesses? Or has India created a system where economic power naturally concentrates into fewer and fewer hands? That question became explosive in January 2023. A report from US based short seller Hindenburg Research accused the Adani Group of serious corporate misconduct, including allegations around stock manipulation and accounting practices. The allegations triggered a massive market reaction. Billions of dollars in market value disappeared. The world watched, and suddenly, one of India's most powerful business empires was fighting a battle not just against falling share prices, but against something even more valuable: trust. Adani rejected the allegations. The company described the report as a malicious attack and defended its disclosures and business practices. And then the story entered India's courts and regulatory system. The Supreme Court later said there was no apparent regulatory failure attributable to SEBI, while also noting that SEBI's investigations had to reach their legal conclusions. The court did not declare every allegation true or false. It dealt with the regulatory and judicial questions before it. That distinction matters because this is where the internet often turns complicated financial stories into simple villains and heroes. But reality is rarely that clean. There are allegations, there are investigations, there are regulatory findings, there are court judgments, and there are narratives created by people who already believe one side. But the bigger story isn't whether one billionaire is secretly a criminal mastermind. The bigger story is what happens when enormous economic power becomes concentrated. And this is where things get uncomfortable. Because Adani isn't the only giant, Reliance isn't the only giant, Tata isn't the only giant. India has built an entire ecosystem of corporate houses whose companies touch critical parts of the economy. And there is a reason these empires became so large. India is enormous. A country of more than 1 billion people needs enormous infrastructure. Someone has to build the airports. Someone has to operate ports. Someone has to produce energy. Someone has to build telecom networks. Someone has to manufacture steel. Someone has to provide software. Someone has to move goods across thousands of kilometers. And large companies can sometimes do things that smaller companies simply cannot. They can raise billions. They can take enormous risks. They can survive long development cycles. They can build infrastructure that takes years before producing returns. This is the positive side of scale. But scale has another side. When one company becomes too important, failure becomes dangerous. When a company controls a critical asset, competition becomes more complicated. When investors become emotionally attached to a founder, skepticism can disappear. And when everyone believes a company is destined to win, valuation can become detached from reality. That is where ambition can turn into risk. And this isn't unique to India. America has its technology giants. China has its state linked corporations. Europe has its industrial champions. Every major economy struggles with the same question: how much power should one private company be allowed to accumulate? But India's story has another layer: family controlled businesses, political relationships, government contracts, regulation, public markets, infrastructure, and generational wealth. Put all of these together, and you get a system that can look almost impossible to understand from the outside. But there is something most people miss. These companies did not become powerful simply because someone handed them power. They competed, they raised money, they acquired companies, they built assets, they made enormous bets. They also benefited from India's transformation into a much larger economy. And that is why calling every major businessman a mafia boss is not just inaccurate. It actually hides the more important lesson. Because mafia power comes from crime and coercion, corporate power can come from something completely different: ownership, capital, infrastructure, networks, brand, scale, and the ability to take risks that ordinary people cannot afford. That can be even more difficult to understand. Look at Tata. Its story is almost the opposite of the stereotypical billionaire empire. Tata Sons is the principal holding company of the group, and 66% of Tata Sons is owned by philanthropic trusts. Tata companies collectively generated more than $180 billion in revenue in 2024-25 and employed more than 1 million people. That doesn't mean Tata is beyond criticism. No corporation is. But it demonstrates something important. There isn't one formula for building a giant. Tata grew through more than 150 years of industrial expansion. Reliance grew through aggressive capital markets, integration, and mass market disruption. Adani grew rapidly through infrastructure, logistics, and energy. Three different stories, three different strategies, one common outcome: scale. And scale creates something money alone cannot buy: influence. Imagine you are a small entrepreneur. You want to enter telecom. You need spectrum. You need towers. You need fiber. You need data centers. You need billions in investment. You need millions of customers. You need years of losses before reaching scale. Now compare that with an existing giant that already has capital, customers, infrastructure, and distribution. The playing field may technically be open, but the battlefield is not equal. And this is the hidden truth about modern capitalism. Competition doesn't always disappear because someone bans competitors. Sometimes competition becomes harder simply because one company becomes incredibly good at becoming bigger. That is the paradox. Success can create the conditions for even more success, and eventually the winner has an advantage that is almost impossible for a newcomer to reproduce. But then comes the critical mistake that investors make. They stop analyzing the business, they start worshipping the founder. The stock rises, the headlines become euphoric. Everyone starts talking about the next big opportunity. The billionaire becomes a celebrity. The company becomes a national symbol. And skepticism begins to feel almost like betrayal. That is dangerous. Because no matter how brilliant the founder is, gravity still exists, debt still exists, competition still exists, regulation still exists, cash flow still matters. And markets eventually ask the question nobody wants to hear: what happens if the story stops working? That question haunted Adani during the 2023 crisis. It terrified investors, it damaged confidence, and it became a test of whether the empire could survive a sudden collapse in trust. The group responded by raising liquidity, reducing certain leverage concerns, and emphasizing its underlying businesses. The empire survived. And that survival created another lesson. Huge companies can sometimes withstand shocks that would destroy ordinary businesses. Why? Because they have assets, they have customers, they have operating businesses, they have access to capital, they have employees, they have infrastructure, they have time. But survival doesn't mean risk disappears. It means the consequences become larger. If a small company fails, thousands might suffer. If a systemically important company fails, the consequences can spread much further. And that is why corporate governance matters. Not because billionaires are automatically evil, not because successful companies are automatically corrupt, but because concentrated power requires extraordinary transparency. The bigger the empire, the greater the responsibility. The bigger the debt, the more important the cash flow. The bigger the valuation, the more dangerous blind optimism becomes. And the more important a company becomes to a country, the more important independent regulation becomes. This is the real story behind India's business giants. Not a secret mafia meeting, not a hidden room where three billionaires decide India's future. Something much more complicated. A country growing at extraordinary speed, a government building infrastructure, millions of consumers demanding cheaper services, investors searching for returns, entrepreneurs willing to bet billions, and corporations racing to control the next decade. Sometimes those interests align, sometimes they collide, and sometimes nobody realizes how much power has accumulated until something breaks. That is the warning, because tomorrow's most powerful company may not be the company with the most factories. It may be the company controlling the network, the platform, the airport, the data, the energy, the logistics, the capital, the infrastructure. And when one company controls enough of those pieces, its success becomes connected to the success of millions of other people. That creates enormous opportunity, but it also creates enormous responsibility. So, are Adani, Ambani, and Tata India's mafia? The evidence does not justify calling them that. They are business empires built through very different histories, strategies, and structures. But if the question is whether India has developed an extraordinary concentration of corporate power, the answer is much harder to dismiss. And perhaps that's the truth nobody tells you. The biggest danger isn't always a businessman secretly breaking the rules. Sometimes the bigger danger is a system where the rules, the capital, the infrastructure, and the market become so complicated that ordinary people can no longer see who holds the power. Because capitalism doesn't require a conspiracy to concentrate wealth, it only requires scale. One successful company becomes bigger. Bigger creates more capital. More capital creates more acquisitions. More acquisitions create more market power. More market power creates more opportunities. And the cycle continues. Until one day you look around and realize something strange. The companies you once saw as businesses are now part of the infrastructure of your life. Your phone, your internet, your electricity, your airport, your bank, your food, your investments, your job. And perhaps that is the most important lesson. Don't hate wealth. Don't worship wealth. Understand it. Because money is only the visible part of power. The invisible part is ownership. The invisible part is access. The invisible part is infrastructure. And the invisible part is scale. The next generation of India's billionaires may not look like the billionaires of today. They may come from artificial intelligence, data centers, defense, semiconductors, green energy, digital finance, and robotics. And whoever controls those industries may have influence far greater than anyone can imagine today. So the real question isn't who is India's mafia? The real question is much more frightening. Who will control the infrastructure of India's future? And when that future arrives, will we have built a system powerful enough to create billion-dollar companies but transparent enough to keep billion-dollar power accountable? Because history has already taught us something. Empires rarely collapse because they become successful. They collapse when success makes them believe they are too powerful to fail. And that is the line every business empire in India and every empire in the world must eventually face.